I was on a panel today actually about industrializing Africa. And I think what really comes to mind is how interlinked everything is. So first of all, you can't really industrialize unless you have the infrastructure in place. You know, you can't have factories if, you know, electricity isn't regular. You can't be producing things if you can't ship them out to where you're selling them easily. So infrastructure is very important. I think the other thing that's very important is trying to integrate value chains across Africa. There are not that many large economies in Africa. If you look at sub-Saharan Africa, there are about 6 large economies, and all the rest are pretty small, and therefore, you know, can't really on their own sustain, you know, big industrial bases without relying on a larger market, which is why the CFTA is actually such an important development for many African countries, because if you're going to really industrialize properly as a continent, we need to actually have those integrated value chains. If, for example, you look in Asia, the value chains are actually integrated. You have Chinese companies producing components in Japan, in Vietnam, which are, you know, assembled somewhere else and then shipped off to the US. So we've got to also follow those kind of models.
We had a session with Emir Kano, and he mentioned about the possibility of Africa trading as a bloc and to serve the continent much better. What's your take on this?
Well, of course. I mean, if you take, for example, the European Union as a bloc is bigger than the United States. So when they're agreeing free trade agreements, for example, they have a lot more negotiating clout. The other thing is that actually we as Africans are going to make much more money and get much more prosperity by trading amongst ourselves, by working with ourselves. You know, we always think, we sit in one country and we think about, oh, what can we sell to the US, what can we sell to France, what can we sell to Latin America, when right next door there's a country that has a market that you could be selling to. But we always tend to think offshore rather than how we can integrate ourselves. And you know, the shame of it all is that, you know, a lot of our borders are actually artificial. You know, they were drawn by people in Berlin more than 100 years ago. So why we're so stuck on those particular borders when we could try and form a much bigger trading bloc, both to trade within ourselves and also to face the outside world, sometimes, you know, beats me.
When you look at the quantity of capital that needs to come in to spearhead the precursors you mentioned earlier, infrastructure, power, you know, and the consistency with which we need this capital coming in, you know, what, as someone who's into structuring deals across Africa, what's your biggest worry?
So the biggest worry is really, well, I have 2 big worries. So the one worry is really just that the fact that they're actually, I mean, while we have a big need for this infrastructure, there are actually not that many deals around that are really bankable. And there are a whole number of causes for that. I mean, it's one thing to have a bad road that you know you need to invest in. It's a totally different matter to turn that bad road into a toll road project. And a lot of work and effort needs to go into it, both on the side of the government and on the side of potential private investors. And that's not really happening. For example, you know, in the power sector, across the whole of sub-Saharan Africa, outside South Africa, maybe you get 2 or 3 IPP projects that close every year. It's really just not good enough. The second thing that worries me is an over-reliance on foreign capital. You know, if you look at most African countries, our savings rates are way too low. Nigeria, where I live, the savings rate, the investment rate is about 15% of GDP, which is roughly equivalent to the UK. The difference is the capital base of the UK is much bigger than that of Nigeria. Most emerging developing countries in Asia, that number is in the mid-30s. You probably have to be in the late 20s, so 25 and above, you know, to really be taking off. The problem with relying on totally foreign capital, and by the way, I have nothing against foreign capital, but the problem with relying totally on that is you're building up a very big cross-currency match. You know, you're borrowing, let's say, in US dollars, but the people who are paying for the projects are paying in Naira. So you have that currency mismatch, which, you know, can cause its own economic problems. So and also then when you're relying on foreign sources of capital, those taps can be closed because something happens well, we're in Korea, so something happens in North Korea, all of a sudden people don't want to invest in Africa because, you know, they're scared of emerging markets as a class. If we're using our own capital, it's not going to be switched on and off like that. So it's very important that we increase our own domestic savings rates and use that for investments within the African continent.